and thank you for joining today's Pacific Life Pension Risk Transfer webinar. All of your lines have been muted for today's call, but you do have the opportunity to type in a question at the conclusion of our presentation. We will also offer a replay, and you may note that today's presentation is available to download for those who are interested. We do have a lot to cover today, so let me take a moment to introduce our speakers. Russ Proctor joined Pacific Life in 2011 as a director in the Retirement Solutions Division. He has over 30 years of experience and is responsible for consulting with companies to reduce and remove financial risk inherent in their pension plans. Russ is a fellow of the Society of Actuaries, an enrolled actuary, and a Chartered Financial Analyst charter holder. Marty Menon has been a director in our Retirement Solutions Division for 4 years. He's been involved in the retirement benefits field for almost 30 years and has held previous positions with other firms such as Prudential, Towers Perrin, now Willis Towers Watson, Mullen Consulting, Marsh & McClellan, and MetLife. Russ, I will hand it over to you to begin today's presentation.
Thanks, Courtney, and thanks everyone for joining us today. The right de-risking solution for a particular plan sponsor depends on their particular situation and the stage their plan is in its life cycle, from an open, active plan to one that is closed to new entrants or frozen for all benefits, and eventually to one that's terminated. It's important to understand the different pension de-risking strategies available to help you manage your pension risk as you manage your plan through these stages. Today we'll talk about some of these different strategies. First of all, we're going to look at the pension risk transfer activity and kind of really try to understand what's going on, why is it so busy, and what's causing that. We'll talk a little bit about the de-risking roadmap, how you can break your liability into different pieces and attack that in a piece-by-piece basis. We'll talk some about the annuity purchase process, particularly going into this busy fourth quarter, what the typical process is and what some of the challenges that plan sponsors are facing. And finally, we'll talk some about the options available with small benefits or the use of a buy-in contract to convert to a buyout. And if time, we may get to insured liability-driven investing as well. So first of all, look at the history of terminal funding or buyout sales in this market. For about 20 years prior to 2012, that market averaged less than $2 billion a year. Then in 2012, it had a huge uptick in sales, driven mostly by General Motors and Verizon that did 2 large deals that year, over $33 billion just for those deals. But even without those two, in 2012, it was still over $3 billion in terms of transactions, so up significantly from 1.7 the year before. And then you can see how it's gone over the last couple years from 4.5 to 9 to over 14 billion. And when we look forward, we don't really see 14 as topping out. When you think about where the whole market is and just the amount of retired liability that's in these plans that are already closed or frozen, there's over 500 billion in retired liability. Most of that will move through to the insurance companies through some type of a buyout. So if that happened over 10 years, that would be 50 billion a year. So we're really just on the early stages of where this growth is going to be. And the last 5 quarters, we've actually had over $1 billion a quarter for each of those quarters, which is kind of a new record for the market. One thing I wanted to point out was the business in these slides is mostly in the fourth quarter. The LIMRA results that we've looked at, when we look at it by quarter, the fourth quarter is by far the largest quarter that we see. In fact, about 55% of the business is transacted in that fourth quarter. And really, when we look at what's causing this large increase in pension risk transfers, and the first reason is really volatility. And we look at the interest rate volatility where the 10-year Treasury, for example, can move 30 basis points in a single month. That can result in an increase in liability of 5%, so plus or minus 5%. The equity market that's been very volatile over these years, where over a matter of a few months you can see the S&P 500 move from below 1940 to over 2100. We've seen that happen a couple times, so you're getting 8% swings in equities, which again can cause your assets to move pretty dramatically. So as you've got these two factors moving your liability and your assets often in different directions, the impact of that is on the plan's funded status. So the graph that we show here is by Milliman. It's the 100 largest pension plans in the United States. The blue bars that you see are the funded status in dollar amounts on the left graph. The red line is the funded ratio, which is the assets divided by the liability. In an ideal world, you would keep that red line above the 100% funded ratio on the right side of that graph. You can see how difficult that's been. There's been a couple of times back in 2000 where it was above that and then dropped dramatically in the crash in 2001, 2002. Finally worked their way back over it in 2007, just to have the crash of 2008 drop that funded status from over 100% to below 80% in just a matter of a couple of months. And this volatility is really causing problems with CFOs, wanting them to look for ways, alternatives to get out of the plan, or at least to stabilize it. The insured LDI solution, LDI stands for liability-driven investing, was really designed for this situation where you try to stabilize that funded status and flatten out that red line for a particular sponsor. And you look over the last 8 years, even with lots of money being dumped into these plans, the funded status is really no better now than it was in 2008, down around 75%. The other reason that's really driving a lot of this activity is increases in expenses. The one we'll look at here is the flat rate portion of the PBGC premiums that plans have to pay. This is a per participant charge. It was $35 in 2012. You can see it's increasing to $80 in 2019, so about 130% increase. So think about that as a Starbucks coffee that you get every morning. If that increased from $3.50 to $8, that would be an increase that you would notice, and you'd want to take some action to change that. The other part of the PBGC premium is the variable rate premium, and this has increased even more dramatically than the flat rate premium. It's gone up almost 400% from below 1% in 2013 to projected to go over 4%, almost 4.5% by 2019. That's assuming that national wages increased to 3%. That premium is actually indexed, so it'll continue to go up as national wages increase. So a lot of companies, when they're looking at this, even at the current year of 3%, they're seeing this is on the unfunded liability in their plans, and they can look at that and think they may be able to borrow money for close to or less than that 3%, and they may choose to borrow the money, fully fund the plan, and then start taking steps to move the plan off their balance sheet. The third factor that is affecting, encouraging these plans to move off is that people are living longer. So it's certainly great for us as individuals that we're living longer. For a pension plan, if they're paying benefits for as long as people live, that means they have to pay those benefits longer, which means it's going to cost them more money. Many plans actually increased the mortality table or updated their mortality table over the last few years, which may have increased their accounting liability by anywhere from 5 to 10%, depending on their population. If you look at the person age 65 in 2014, for example, the male is expected to live 21 years and the female 24 years to age 89. But in fact, the pension plan, a lot of these benefits may be in joint and survivor type benefits. So the pension plan is really paying until the last of those couple is alive with 100% joint and survivor benefit, for example. So they really have to pay that benefit until age 94, and that's on an expected basis. So a large plan may be able to look at that life expectancy as what they would think to pay. A smaller plan or even an individual planning for their own retirement really has to look at, you don't just want a coin flip to run out of money, that you really need to plan a longer period of time. And in fact, the couple has a 20% chance that at least one of those will be alive at age 100. So really a 35-year planning horizon for them. So we'll talk a little bit now about the de-risking roadmap, as we call it. And this is how plan sponsors are looking at their plans, and particularly the population, and breaking it up into pieces. So we've shown the pie chart here of vested terminated participants, active participants, and retired participants. And a lot of times each of these groups is attacked separately. We're seeing a lot of lump sums offered to the vested terminated participants as one of the most efficient ways to transfer that risk and that liability off the plan sponsor's balance sheet and to the individuals. The other thing we're seeing a lot of is for the retired benefits to focus on the small benefits. When we looked at those PBGC premiums before on the per participant basis, plans are analyzing that and realizing the small benefits may be the most efficient as the next step to buy those out, move those off the balance sheet and out of the plan. Other strategies used for the different populations could be liability-driven investing, the LDI, or insured LDI. Also a new solution is the buy-in that's starting to be used more and more here in the U.S. And very popular in the U.K. And then finally the buyout is where most of the volume of activity is, and that's the ultimate solution that is going to move that liability off the balance sheet and out of the plan to an insurance company. So a little bit about the annuity purchase process now. This is particularly important now that we're going into the fourth quarter and a lot of this activity is going on. The first thing is the selection of the annuity provider. The Department of Labor issued an interpretive bulletin 95-1 that gives guidance on the criteria that plan sponsors should look at as they're selecting an insurer. It's really important as a fiduciary are choosing a safe insurer. Most plan sponsors use an advisor to help them through this process, but looking at things like the quality and diversification of the annuity provider's investment portfolio, the size of the insurer relative to the proposed contract. Next one would be the level of the insurer's capital and surplus, other lines of business that the annuity provider may be involved in, just to look at other risk exposures they may have. And then finally the structure of the annuity contract, if it's a separate account or a general account product that they're using. All these are looked at to really analyze the companies, make sure the ones that you're including in the bidding process meet your criteria for being a safe insurer. Then on the next thing to consider as you're going through this process is your participant data. Sometimes this is sort of an afterthought, but it's important to make sure your data is clean really before you start this process. And the better that your data is, the better likelihood you're going to get a good annuity price from the insurers. We certainly do look at that when we see bids where the data is a mess. We know it's going to be more of a problem to get it onboarded and cleaned up. So having nice clean data is going to give us the opportunity to give you the best price available. When we come to the preliminary bids, this is one thing we encourage to put out your preliminary bid as early as you can when you've got the clean data available. And this is for two reasons. One, it gives you an idea of where the pricing might be for your annuity, but it also gives the insurance companies the opportunity to code all the different provisions of your plan and make sure they understand that, have it all ready to go. So you can do that earlier. It's easier to update those bids once we have it all coded on our system. And particularly when you're looking at a preliminary bid, it's better to bring that earlier in the year rather than in the fourth quarter. Because we do see situations where we're so busy in the fourth quarter that when someone brings a preliminary bid, we may decline on bidding that just because of the availability of time. We're just too busy to bid on that at that point in time. So good to bring those early in the process. Then finally, on the bid day, you do want to make sure that your company decision makers are available. We have seen situations where the key person that needs to make the decision or sign the sales contract is not available, and then the bid day has to be repeated, as these bids are typically only available for that day. It's interesting, we've seen over the years that the bidding process can be multiple rounds or a single round. I think it used to be more rounds historically. We're seeing it getting less and less rounds as I think everyone's getting busy. So there may just be 2 rounds on the final day. Often it's a one and done where there's just one bid and that's all you're allowed to put in. I think we kind of like the situation where it's mainly 1 round for the final, but perhaps the intermediary will go back to the top 2 or 3 bids and allow them to refresh. I think that's one thing to consider as you're going into your final bids. And the final step is, as you select the insurer that you're going to go forward with, is the implementation on that process. So the insurer will collect all the additional data that we may need, the banking information, all of that, all the information that will be needed to issue those checks or provide the electronic payments to your participants. Really the focus is making sure those payments are made accurately and on time on the start date that you've selected. The actual contract signing and annuity certificates usually are issued several months after that start date. Again, the focus is getting the payments out on time. The final contracts can be signed later once all the attorneys have had a chance to look those over. Just a couple things on Pacific Life. One of the things that the intermediaries will go through as they're looking at analyzing different companies. With Pacific Life, we've been around for a long time, since 1868. We are a mutual insurance company, so we think that gives us advantages. Having a long-term outlook helps us take on this risk and look at for the long term and not just quarterly reporting. We've been in the group annuity business actually since 1941, so been in this for quite a long time. About $137 billion in assets and $9 billion in equity. Also very proud that we rated to AA- by Standard & Poor's. So that's, I think, indicating that we've been managing the company well for a long time. So some of the annuity purchase process challenges. Marty, do you want to go over some of these?
Yeah, thank you very much, Russ. Russ mentioned earlier there was a slide that unfortunately didn't come up on the screen, but our intent was to show everyone the volume of annuity purchases that occur over the course of the year, and the point there being that an enormous amount of transactions occur in the fourth quarter. So as Russ mentioned earlier, when you're thinking about doing an annuity purchase, a preliminary bid in particular, it's very possible that insurance companies may actually pass on providing a company a quote if that quote is merely a preliminary quote. In fact, last year, and one of the reasons we wanted to bring this up, there were a number of carriers who actually declined to bid on deals that you would think they would normally bid on. So the fourth quarter tends to carry about 50%, 50% of the transactions that occur in any given year. And we just wanted to point that out to the folks that are listening so that, for example, this time of year to try and get a transaction completed, you're almost, believe it or not, here now at Labor Day, as we head into the fourth quarter, you're almost a little bit late. That's why we're trying to encourage plan sponsors, our consultant partners, et cetera, to get those bids out, especially those bids that involve deferred participants. We mentioned deferred participants because they involve more programming in terms of how we run our valuation software and how we determine the price. As you will often hear, insurance companies love those participants who are already retired. But deferred participants have benefit options, early retirement factors, the ability to select a lump sum perhaps, and we'll talk about that in a second. But point being is that if you have a retiree-only transaction that you're seeking to complete, That's fairly easy to do. However, if you're including deferred participants, it's really important to start working on that now if you want to try and get that transaction done by the end of the year. Small plans are something that we're also seeing quite a bit in terms of plans that, roughly speaking, are under $5 million. Now, each carrier has their own interest in plans of various sizes, but again, to emphasize what's going on in the marketplace as we head into the fourth quarter, you may find on a plan that's relatively small that some carriers are not even interested in bidding on those, and that may reduce the number of insurance carriers that provide you a quote. So when we say small plans, we're roughly talking about that under $5 million, perhaps under $10 million limit. We too see plans that are a few $100,000. Those are unfortunately difficult to work on this time of year when we're very, very busy. So again, we wanted to point out that small plans coming to market this time of year, you may find a lack of interest from the insurance industry. Lump sum options. Now, lump sum options are an interesting feature of plans because a lot allow participants to take a lump sum if they have not yet retired. Now, some are limited, and that, in a sense, is a good thing. In other words, the plan may have a benefit provision that says you're allowed to take a lump sum if your total present value of your benefit is under $10,000 or under $15,000. If there's an unlimited lump sum, in some cases, carriers may be reluctant to provide a bid on those types of situations. So again, just to create awareness in the marketplace, plans that offer those liquidity events, if you will. In other words, it's hard for us to plan as an insurance company, are these deferred participants going to take a lump sum, or are they going to elect an annuity? We have to remain somewhat liquid, so we're always paying attention to lump sum provisions in the plans that we look at. That also affects cash balance plans. Those of you who have cash balance formulas in your plans may find that certain insurance companies will not provide you a bid. We, at the moment, are not interested in cash balance plans. And that also has to do with the availability of a lump sum where a deferred participant can say, gee, thank you very much, but I'm not interested in an annuity. I would much rather just take my lump sum, perhaps roll it over to an IRA, and pull my money out of the plan. So that also involves how we price these types of plans. And again, cash balance plans are something we currently don't bid on, and I think you'll find that there are very few insurance companies who do. Odd benefit provisions. It's an interesting way to describe it, but what we mean is benefit provisions that are unusual. Benefit provisions that, for example, might involve pop-ups or integration with Social Security or unusual annuity forms. And we see some very interesting benefit provisions as we analyze the plans that are brought to market. Sometimes there's multiple buckets. In other words, other payments that come out of pension plans. Some are to pay for Medicare insurance premiums. Some might be for paying retiree life insurance premiums. The more odd and unusual things that are involved in your benefit formulas, the more, A, it's going to cost you to transfer those liabilities to an insurance company, but also, B, the more that carriers may not be interested in participating in the bidding process at all. So if you can change some of those things and figure out a way maybe to either increase the benefits, or, for example, we've seen plans that have multiple early retirement factors. Maybe you can move from 3 early retirement factor tables to the one that reduces benefits the least. It's not easy to do, but it's something that obviously has to be done well in advance of bringing the plan to the insurance marketplace. But again, just to inform the plan sponsors that are out there, we want to make sure people understand that there are things that some insurance companies may not be interested in bidding on, and if you have an opportunity early on in the process to modify those provisions, that may actually benefit you as a plan sponsor in the long run. We're going to switch and talk about buyouts really quick. You know, as Russ mentioned, the most common form of transaction that we see are still buyouts, and a lot of them are not full plan terminations. A lot of them are for portions of the participants in the pension plan. The good thing about a buyout, as many of you know, is that it transfers all the benefit obligations and the pension obligations to the insurance company, removes the liability from the plan sponsor's balance sheet. Also, once you take those participants out of the plan, at least for those per participant PBGC premiums that Russ talked about, which are increasing every year, by pulling those participants out of the plan, and again, we'll talk about small benefits in a minute, that reduces your PBGC costs, and then we, as the insurance company, take over all of the servicing for those annuitants. If they move, if they change banks, especially for those who are deferred as they begin to elect their benefit provisions, etc., that falls on us. So it's a great way for a plan sponsor to begin to reduce their pension liability by transferring a portion of their participant group to us. And again, in some cases, it's a full plan termination, maybe happening after a lump sum offer has been provided to those who are deferred, so that you can reduce the number of deferred participants, etc. And point being, there's a lot of strategy here. You know, we often hear from financial advisors and consultants who haven't really done a lot of these transactions. We encourage plan sponsors all the time to engage with an experienced consultant, someone who has done a lot of the work and worked on other plans, seen a lot of different things, and really have a team put together that you have experienced people helping you as you navigate this marketplace. One of the things we always talk about is small benefits, and very quickly we're going to move through a couple of slides here. The economic cost versus the actual cost for annuities is something that we talk about all the time. You've probably seen graphics like this. The gap liability is really your base cost, if you will, and in some cases we've seen annuity purchases that are either right at your gap liability or just below. But the gap liability, the generally accepted accounting principle, your book liability, only involves your present value of your future benefit payments, which, as Russ mentioned earlier, you probably updated with new mortality assumptions that were released by the Society of Actuaries. So your gap liability may have increased anywhere from 5 to 10%. In this case, we're showing a 6% increase in that basic gap liability. Then as you do your economic cost analysis, you've got to look at your administration costs and your PBGC premiums, and then your investment costs for all the various investments that you have. And in this case, we've assumed about a 50 basis point per year cost for that investment management expense. And then the other thing that is kind of a soft dollar cost, but certainly exists, is what would it cost you to protect your funded status? As we showed earlier, the funded status volatility over the last several years has been enormous. If you could imagine the cost to purchase protection, because that's what you get when you transfer liabilities to an insurance company. You no longer have that default risk. You no longer have to worry about your bonds being downgraded or your stock portfolio moving up and down, as we discussed with the S&P 500. So that is an implied cost, which some analysts will assume roughly costs about 30 basis points a year, but think of it as protection around your investment portfolio. When you add all of these costs up, this is when we talk about economic cost. And what does that mean in relation to the cost of an annuity? So on small benefits in this case, if you added up those costs that we talked about, admin and PBGC premiums, investment management expense, your default risk. If you added those up, particularly for small benefits, you may find that your economic cost is approximately 113% of your gap liability, and yet when you bring those participants to an insurance company and price out an annuity for those small benefits, you may find that your annuity cost is actually less than your economic cost, and it's going to differ, no doubt, from plan sponsor to plan sponsor. But in some cases, and I've heard from consultants, that particularly for retiree-only annuity placements, the cost to annuitize has actually even been slightly less than the gap liability. So we're talking 100%, not 105, actually 100% of your gap liability for the annuity cost. Now again, that's going to vary from plan to plan, and it'll change over time. It may change depending upon how busy the insurance companies are and how aggressive they want to be on pricing these annuity placements. But we want to point this out again for the plan sponsors that are out there, that while you may have thought that annuities are expensive, when we look particularly at the smallest benefits in your plan, you may find that annuities are actually far less expensive than the economic cost of carrying those liabilities in your plan. One of the other things we want to talk about very briefly is the concept of a buy-in annuity. We refer often to the buyout annuity as fully carving your participants out of the plan and placing the annuity with an insurance company. A buy-in is a little bit different. As Russ mentioned, it's a very common transaction in the United Kingdom. We've done a few of them here in the United States, and a buy-in is really nothing more than an annuity transaction where the plan sponsor holds that annuity contract inside the plan trust. That's why it's referred to often as a buy-in. It stays in the plan trust. Now, why would a plan sponsor want to do that? Well, for one, if they keep that annuity in the plan trust, they don't necessarily have to recognize settlement costs that may have to be recognized when they do this transaction. So when the contract itself and the value of the contract remains inside the trust, it really is just an asset play. You don't have to notify participants. It may not change the plan's funded status, because you're really moving, if you think about it, from one block of assets, now purchasing an annuity, keeping that annuity inside the plan trust, and assuming nothing else changes, your funded status may remain the same. The point about communicating to participants is important, because this buy-in annuity is just an asset play. You don't have payments going directly to participants. The insurance company that's providing the plan sponsor the buy-in contract simply writes a bulk check every month for those benefit payments that are covered under the buy-in contract. So that bulk check goes to the plan trust, and there's really no need to notify participants. So the point being is, this is a decision by the plan sponsor to move into an asset that more directly and in some cases more effectively protects the plan sponsor from longevity, from assets moving around, from other things that may create volatility. That's what you're going to do anyways in the long run here. So in a sense, the buy-in annuity is just a shorter term transaction that you can then convert, by the way, to a buyout at a later time. We mentioned revocable there because in some cases the buy-in annuity may actually be revocable, so that the plan sponsor could change their mind and say, I don't want this annuity contract anymore. So there are a variety of plan designs out there. Again, the point being, flexible tools for the plan sponsor so that they can choose to de-risk their plan as they see fit. A buy-in may make sense if you have an underfunded plan. As I mentioned, it's possible that the buy-in transaction will not change your funded status. Again, if you have recognized losses and you may have to acknowledge some settlement accounting charges, and perhaps if you're not ready even to terminate your plan at all, but you want to begin to de-risk, a buy-in could make a lot of sense to purchase those annuities but hold them inside the plan trust. I mentioned we've done some buy-in transactions. Really quick to show you a case study, we had a client who specifically wanted to delay the recognition of their settlement costs, and they came to us last year in August and said, we'd like to cover this group of retirees, and we want to do this right now in 2015 with a buy-in contract. So we issued that buy-in contract last year in August. They waited for the calendar year to change over until 2016 when they were fully ready to terminate their plan. They then wrote us a letter, that's all it took, wrote us a letter, we converted that buy-in to a buyout, and then we issued certificates directly to the participants. We then started paying the participants directly in April of this year. The plan sponsor then recognized their settlement accounting costs, got ready to fully terminate the plan, and this allowed the plan sponsor to recognize that settlement cost and that actuarial loss in 2016 instead of 2015. And for those of you who are familiar with what happened to interest rates, this plan sponsor was very pleased that they chose to do this transaction in 2015 versus 2016 because interest rates had dropped pretty dramatically this year, and it allowed them to do the transaction for a lower price than it would have cost them had they done this in April of 2016. So that's one example where a plan sponsor transacted a buy-in and found it to be very beneficial. So we're going to stop here and see if there are any questions that are coming from the audience.
Thank you, Marty. So that concludes our presentation today, just in the interest of time. Let's take a moment and we'll see if any questions have come in. If we don't get to your particular question today, either Russ or Marty will reach out to you after our webinar concludes today. So you'll hear from them either today or later in the week via email or telephone if they have your number. Okay, so Marty, our first question I'm going to pitch out to you, and that is, how do you define small benefits?
It really does vary from plan sponsor to plan sponsor. It seems that most of the time when we've seen plans that are carving out that smaller group of benefits, that they're looking at monthly benefits in the neighborhood of $300 to $400 a month. Again, it goes back to the expenses. When you look at the expenses and you begin to tally up that economic expense, and not just the PBGC premiums, the per participant premiums, but the other things that you're paying as a plan sponsor, you can kind of come up with a rough number, and then when you do that calculation, you can say to yourself pretty confidently, wow, these people that I'm writing a check of $250 to $300 a month, these are the expensive benefits that I have in my plan. These are probably the first people that I want to transfer to an insurance company. So roughly speaking, I think we're seeing a pretty common fence, if you will, around $300 to $400 a month.
Great, thank you. All right, this next question that we have, Russ, I'm going to reach this out to you, and that is, how do you think the volume of deals in 2016 will compare to 2015?
Well, I think we're busier than we were in 2015, and in talking with the consultants and other advisors that we work with, it sounds like most of them are busier than last year. In terms of the total volume, it's hard to say really if it's going to be more than the 14 or 15 billion last year. A lot of that's driven by some of the larger deals that get done. I know there was a deal done in the third quarter of about 1.6 billion. And there's a few other large ones out there, but depending on whether those close in this year or next year will kind of depend where the overall number is. But I think in total we are busier than we were last year.
All right, thank you. This next question, Russ, actually I'm going to pitch this one over to you as well, and that is, I have heard some insurance companies do not like deferred participants. Why is that?
Yeah, we talked about that a little bit earlier, but I'll kind of touch on that in a little more detail here. The deferred participants, a couple things with those. Retired participant is very easy because we have the benefit amount is known, the optional form is known, a little easier to predict. It's a shorter duration. They've already started retiring, so we're not going to be holding that money for as long, so it's easier to invest for. Deferred participants typically are going to be younger. There's a longer duration on that liability. There's also lots of unknowns in terms of what are the early retirement factors that are being used, what optional form are they going to select. So a lot of different things with deferred participants that make them a little more difficult to invest for and to price for. And so we tend to like retirees more than deferreds, and I think there's other insurance companies are like that as well. And I think that ties into the lump sums that are being offered for deferred participants that often will get you a better price when you bring the bid to an insurance company. If you've got more retirees than deferred, you might get a better bid. And we usually like to see that the deferred liability is less than the retired liability when you look at the total package together.
All right, perfect. Okay, and then we've got one more question, or time for one more question in the interest of time. And Marty, I'm going to reach this out to you, and that is, can I use a buyout or buy-in for a non-qualified SERP?
Well, for a non-qualified SERP, because of the nature of the benefit that's being offered to those people that are participating, a buy-in really makes a lot of sense. And I emphasize that because if you issue certificates to the participants in a non-qualified SERP, you create immediate taxation on the whole present value of that annuity stream. So we did a transaction earlier this year, and we started to hear a lot more interest because the SERP benefits tend to match the same benefit provisions that are offered in the qualified plan. So in a non-qualified plan, there's often a mirrored benefit that's being offered, an annuity stream, if you will. And so a buy-in annuity makes a lot of sense because it can be kept at the company level, or if the company's using a rabbi trust, we would then make a bulk payment to the rabbi trust. Then the rabbi trust would actually distribute those payments to the participants, keeping that separation between the insurance company and the participants in the plan, and thus avoiding that problem of immediate taxation to the participants. And that way now, the company or the rabbi trustee has a great asset to use to make those SERP payments for those participants. And that buy-in contract can be held for the duration of that plan, in other words, until all of the benefits are paid out. So an annuity as a buy-in contract can make a lot of sense for those plan sponsors that are offering a mirrored annuity payment to their qualified plan via a non-qualified SERP for those typically executive participants.
All right, thanks, Marty. As a follow-up, actually, we just had another question come in, and I just wanted to reach this out to you. Are there any size maximums, minimums for buy-in?
Yeah, great question, because SERPs are interesting benefits because they make up all the lost annuity payments that you typically lose in a qualified plan. So yes, there are what we might refer to as underwriting limits. The CEO's benefit tends to be the largest. In other words, the CEO loses the most typically out of a qualified plan. We don't want to necessarily just underwrite the CEO's annuity. We like to see a spread of risk. So hopefully there will be multiple participants in the plan that we can cover in the buy-in annuity, and thus will spread our risk, if you will, over multiple lives. So each situation is different, but that's an excellent question. We want to see the census. We want to see who else besides the CEO and the CFO are participating in the SERP, and we do want to spread our risk out. So every situation is going to be a little bit different, but great question, because yes, sometimes we are approached with, hey, I want to buy an annuity, a buy-in annuity just for the CEO, and oh, the CEO's benefit is $1 million a month, to be somewhat exaggerative, and we really don't want to write an annuity that large on one life. We would much rather write that buy-in contract covering multiple lives so that we spread our risk as well over a group of people versus trying to cover just one or two people.
Yeah, and Mario, to add one thing too as well, when you're looking at the buy-in for a qualified plan, the maximum and minimums there, if you're looking at an overall purchase price, would have similar underwriting for a buyout. So again, in this busy fourth quarter, if you brought a buy-in of less than $5 million, we might not be interested in that, whereas we might be if it was first quarter of next year. So similar size limits on a buy-in as a buy-in on the qualified side.
All right. Thank you. All right. Well, in the interest of time, that actually concludes today's webinar. Thank you to all who have attended. We do know we have several additional questions here, so just note that if we didn't have a chance to answer it on today's webinar, we will get back to you in the coming days. Either Russ or Marty will reach out to you. So we will also offer a replay for those interested in listening again, or if you'd like to share it with others that were not able to participate today. So thank you for attending the webinar, and have a great day.
Thank you.
Bye-bye.